let's talk about the different elements that make up the structure of a loan.
When developing a loan structure, the first thing to do is to establish some general provisions for the loan. This is important, especially when dealing with companies that are involved in different types of activities in different markets, using different forms of organization. Some companies also operate under a brand name that is different from their legal entity name. So at this point, we want to make sure that we have detailed information about exactly who the borrower is. It is also necessary to find out whether there will be guarantors for this loan, and if so, who they are. A guarantor is a person who legally accepts responsibility for a borrower's debt in the event that the borrower fails to repay the loan. In our transactions, the guarantor is usually an organization related to the borrower, usually being either the borrower's parent or a subsidiary. Having a guarantor usually helps us reduce risk on any loan we make because if the borrower defaults on the loan, it is transferred to another legal entity. Lender. Speaking of a typical transaction, we are talking about a company that makes a loan. For most Goldfinch loans, the lenders will be a group of individual backers who, after evaluation, select certain pools of borrowers. In typical transactions, loans come in two types. The first is a term loan. This is a loan in which the lender lends the borrower a lump sum of money, also called principal, on the condition that the borrower repays it according to a predetermined repayment schedule. The second type is a revolving loan, or a revolving line of credit, which is a type of loan that depends on the needs of the borrower. In this case, in contrast to a term loan, the borrower has the opportunity to repay and receive again any amount of the loan as many times as he wants, provided that the total amount outstanding at any period does not exceed the established amount of credit. Under this type of loan, the borrower is given additional flexibility because interest is to be paid only on a portion of the amount borrowed, not on the total amount of the loan. Now let's try to determine the seniority, or order of priority, of the debt claims on the loan. Seniority here refers to the order in which the borrower's debt will be discharged in the event of bankruptcy. The debt with the priority right of claim in accordance with the order of priority is called the senior debt. And the holder of the senior debt has a preemptive right of claim to the assets of the company. All other debt is called subordinated debt, in relation to the senior debt, which means that in the event of bankruptcy, the borrower must first pay off the senior debt in full and then pay off the subordinated debt. For this reason, holders of senior debt are usually paid a lower interest rate than holders of subordinated debt, because their debt obligations are considered less risky. It is important to mention that senior debt is also often, though not always, secured debt. I will go into more detail about collateral a little later, but in a nutshell, secured debt is that debt for which the borrower has provided certain assets as collateral. Senior debt, which is also secured debt, is called senior secured debt. This type of debt is often considered the highest priority and least risky type of debt for a company. It is generally the type of debt that we favor, especially in emerging markets, where risks tend to be higher. Next, let's talk about the size, currency, coupons, and terms of the loan. As the name implies, when we talk about the size of the loan, we are talking about the total amount of the loan. It is usually based on the needs of the borrower, weighed against the amount the lender can lend. There are variations of this. For example, in the case of a committed, guaranteed line of credit, the lender agrees to give the full amount on pre-agreed terms. Also, a loan can have a committed and an uncommitted portion, in which case the lender will only commit to provide the borrower with a committed amount, while reserving the right to provide the borrower with the uncommitted portion as he or she sees fit. Also, to avoid ambiguity, we clearly define the currency of the loan to be granted. Usually on Goldfinch we use USDC stablecoins. Then there is the coupon, which is the annual percentage that the borrower pays on the loan. It is determined by a number of factors, including the queue of debt claims and the security of the loan, the maturity of the company, the market in which it operates, and the type of product it offers. Frequency of interest payments. Regarding the frequency of interest payments, It is a question of how often interest payments will be made. For Goldfinch loans, interest payments will be made monthly. When we talk about a principal repayment schedule, we are referring to a predetermined schedule by which the borrower must make principal repayments. Loans are usually subject to either lump sum repayments, in which case the loan itself is called a salvo loan, or bullet loan, whereby the entire principal must be paid at the end of the loan term, or amortization repayments, where the principal must be paid back in installments according to an agreed schedule over the life of the loan.